Hi friends, this is CA.SP.Palaniappan here with a small update on the direct tax proposals of Finance Act 2022 presented by Madam Nirmala Sitharaman today. It's only a small update because of the fact that the direct tax portion in the budget speech by itself was very small. I was ready with my paper and pen to note down all the changes, and in 3-4 points the entire direct tax session was completed. So yes, it was one of her shortest budget speech. However, I have a 6-point agenda of important changes which I will take you through, which I'm sure will be helpful. So number 1, let's deal with the most asked question today to me by all my clients, and also I'm sure that this would be the first question in every common man's head. Has the tax slab changed? Do I get a bigger exemption, a bigger threshold limit? Are there more deductions? I'm sorry, just like the last year, there are no changes in the tax slab in the current year also. There are no increase in your ATC or your usual deductions also. So that by itself is a little bit of a disappointment to the common man. Next, let's move on to the most buzzing topic of today, the crypto tax. The government has introduced a proposal to tax the gains made on sale of cryptocurrencies at a 30% flat rate. So as all of you know, cryptocurrencies are the most trending thing today. Every investor, young or old, wants to put their money into cryptocurrencies, majorly because the returns can be multifold. There are even instances where returns have been as high as 600-700% within a span of 3 months. Many of you know the Dogecoin, which was probably trading at 2 or 3 rupees, went up to 40-45 rupees after Elon Musk's tweets and was back to 10 rupees, trading at 10 or 11 rupees today. So the volatility is very high, and the potential to make a bigger return is also high in crypto. So in those cases, the government, I think, also wants a share of the pie and has said that there will be a 30% tax on gains made on these cryptocurrency sales. And also, they have levied some additional conditions. What are these? Number 1, in calculating the profits from these cryptocurrency transactions, you can only reduce the cost and no other expenditure is allowable. Let's say you've spent some amount towards paying to a site for analysis of these cryptocurrencies. You've bought a laptop and you want to write off depreciation on that. All those other expenditures are not allowed. You only have to reduce the cost to find out the profit from these cryptocurrency transactions, and those are taxed at 30%. Number 2, if you made a loss in this cryptocurrency transaction, let's say you bought the crypto for 10 and you've sold it probably for 5, so you made a loss of 5. That 5 rupee loss cannot be adjusted against any other head of income. Let's say you have a income from house property of 1 lakh rupees. You cannot set off this loss against income from house property or any other head of income. So these two are important conditions that accompany this crypto tax. Further, everyone now has a mobile app for these cryptos where they buy and sell. So how is the government going to track all these transactions and find out if we've made a profit or we paid tax? That's why they've also made one more enabling provision where 1% TDS is to be deducted and paid in case of these cryptocurrency transactions. So that is a mechanism to track whether we've made profits, and TDS will be deducted, which we can claim in the return of income. So now let's move on to the next item on our agenda, updation of returns. Madam Nirmala Sitharaman introduced a new provision saying that there may be instances where taxpayers realize that they have missed to declare an income in the return file. But by the time they realize it, the due date of filing the return is also over. The due date for filing a revised or belated return is also over. So what can you do now? You cannot file the return. So to enable the assessee to correct the error, she had proposed this new provisions where you can update the return up to 2 years from the end of the assessment year. This is a good provision only. All of us do sometimes forget to add something in the return. Probably we would have missed out SB interest to be added in the return. So she said, to enable the SSC to correct the error, I am providing that within 2 years you can update your return, show this additional income and pay the additional tax. That's what she said. When she said that, I was very happy because this is a very good provision, a relaxation given. Later, when I go through the fine print of the budget, I see that this provision has a slight twist. She's saying if you declare an additional income, we do not only have to pay the additional tax on that income, we also have to pay an additional tax of 25% on the original tax. So let us say I update my return with an additional income of 1000 rupees. On this additional income of 1000 rupees, I have to pay 30% tax. So that 30% tax will work out to about 300 rupees. That I am ready to pay. But what she is saying is, other than this 300 rupees, I have to pay an additional 25% on this 300, which will be about 75 rupees. So that by itself is penalizing, and that is only if we update the return within 12 months. If we do it after 12 months, but before 24 months, the additional tax is 50%. So I am declaring an additional 1000 rupees as income, and in that 1000 rupees, 300 rupees will be my tax liability. In that 300 rupees, I have to pay 50%, which is about 150 rupees extra for declaring this 1000 rupees, which I think is extremely penalizing. So I think, see, if the department finds out that we have missed an income, they are at liberty to penalize us and put a penalty of 100% of the tax liability. So I think probably Madam thought this is a far better option where the assessee themselves come up, and instead of 100% penalty, they can suffer 25% or 50% by themselves. So, so anyway, that is a new provision that has been brought in. We'll have to wait and see how many people will opt for it given this 25% and 50% penalty. Moving on, the next major update is a welcome update. It's the rationalization of surcharge on long-term capital gains. As you know, my friends, the surcharge in our country works like an elevator, right? So at each different slabs of income, you have a different level of surcharge. It starts from 10%, goes to 15, goes to 25, and goes all the way up to 37% also. So, but however, surcharge on equity listed shares was capped at 15%. They said if you had a capital gain because of listed equity shares and your income was probably even 10 crores, you don't have to pay the highest surcharge limit of your 37%, and you can still pay your 15% surcharge. Now this benefit of this capped surcharge at 15% has been extended for all long-term capital gains, irrespective of whether it's a listed share or not. So any long-term capital gain, including land or building or unlisted shares, a lot of employees who got these employee share options, who were selling this, were facing this issue because they had to pay a higher surcharge. But now, since it's capped at 15, it is a major relief for most of these people. The next update is relating to TDS on immovable property. All of you know that TDS has to be deducted at 1% on the consideration that is going to be paid for purchase of immovable property. Any person purchasing an immovable property for more than 50 lakhs has to deduct TDS at 1%. But many of you might know that the corresponding section, section 50C, has a specific clause which says that capital gain for the seller is to be admitted on the consideration value or the stamp valuation, whichever is higher. That is what 50C says. So they have brought in that same clause here, and they are saying that TDS at 1% has to be deducted on the consideration or the stamp duty value, whichever is higher. So in case you are purchasing a property for, let's say, 70 lakh rupees, but the stamp duty value of that property is 80 lakh rupees. You have to deduct 1% TDS on that 80 lakhs and not the 70 lakhs. Finally, the last amendment I have for you today is also a welcome amendment. In fact, the department had come out with a circular that they will be making these amendments, and this is a retrospective amendment effective from 1st April 2020. It gives relief for amount received from employers and others towards an assessee who is suffering from COVID or who has spent money on his treatment for COVID, or a deceased person's relative who has received some money on behalf of the deceased person. So this is a welcome move. The government had already said that any person, any employer who is going to pay his employee, or if any other person gives any money to a person who has been affected by COVID or his immediate family member, then that amount will not be taxed in the hands of the individual, which is a welcome move, because this money has been received by that person only to treat himself for this disease, and during this pandemic this should not be added as a burden and taxed extra in the hands of the assessee. And also, if the employer pays the family member of a deceased person any amount, or any other person pays the family member of a deceased person an amount up to 10 lakhs, it is exempt in the hands of the family member and they don't have to pay tax on it. So with these 6 major items, I would like to bring this update on budget session 2022 direct taxes to a conclusion. Thank you so much for watching. Stay tuned. I will try my best to come up with more videos on direct taxes.